Okay, very quickly. Aaron Furniture in terms of financial forecasting. For Friday, you need to know the difference between cash flow forecasts and why businesses need them. Very quickly, a cash flow forecast shows estimated incomes or money coming into the business. It also shows estimated outgoings, expenses or payments. And it also shows estimated timings of the money coming in and payments going out. So once we know when they are happening, we can make sure we've got enough money to do it. Cash flow forecasters also show estimated cash balances at the end of a month period. So after the end of June, July, August, September. And if those cash balances are negative, we need to get some cash quickly. So what the cash flow doesn't show, it doesn't show us that the profits are involved in a business, and it doesn't show us any actual figures. It's just a guess. Cash flow forecasting is a best guess based on last year's performance and what we think this year will happen. Why do businesses forecast cash flows? Well, a business needs to plan, and part of that planning process will involve spending money. Aaron Furniture are looking at spending loads of money at the moment on new factory, new premises, new equipment, biomass burner, new people, blah blah blah. So to do that, they need to know what cash is available to them and when they can get their hands on it, and they need to know if they will have access to different sources of finance to do all that stuff. So what might cause a business to suffer from cash flow problems? That could be an easy 6-mark question on Friday. Lots of things from the list. If there's lack of sales or lack of revenue coming in, that could be a short-term loss, which is quite significant to Aaron Furniture. Aaron Furniture could be suffering from over investment in production, which could actually cause them to have bigger factories, more machinery than they need, have more stock than they know what to do with. All those things will couple up to poor cash flow. So if they increase their capacity to make furniture and that demand isn't there, they will very quickly run out of cash, creating that opportunity. As a result of that, they could have a poor credit rating, which means ultimately their credit control will have bit the dust, and they could, if they're not careful, cause themselves to be over trading if they're growing too quickly. An example of over trading would be supplying more than one supermarket a year with products, and eventually you can't afford to do that because supermarkets are taking so much stuff, so you might decide to take on a different supermarket every 2 years as opposed to too many supermarkets in fewer years. Aaron Furniture probably won't be suffering from seasonal demand, although I wouldn't imagine people buying much furniture in the summer if everybody's on holiday. If we have got a cash flow problem question on Friday, and that question is, how can the business address cash flow problems? Aaron Furniture could look at what costs it can cut, reduce the stock it's holding and maybe go to a just-in-time process as opposed to carrying lots of stock on site. It could delay payments to suppliers through trade credit. It could reduce the credit period offered to customers to pay for goods by insisting that they pay like you do for a BMW when you order it, so that BMW aren't chasing for the money once they've delivered it. They could delay or cut back plans to expand the business, although it seems to be a significant push to buy a new factory and to supply outside the UK new customers. And it could look at borrowing cash sources of finance for temporary problems that it's experiencing. So lots of things it can do to deal with the cash flow problem there on Friday's exam. If you get an exam question to say what is profit, what is loss, or what's the difference between profit and cash flow, you should be able to ace those now quite quickly. Obviously profit is the surplus of money that's left over after all the costs have been paid. The equation for profit is total revenue minus total cost. Profit's not a dirty word, it's the business owner's reward for taking the risk. So in this case, Aaron Furniture and the directors of Aaron Furniture, their reward is what they get for managing that business and taking it from on the brink of going under to a successful, thriving British company. With that profit, they can reward themselves as directors significantly with dividends. They can punch more money back into the business, or they could do the third thing and save a chunk of that money for the rainy days in the future. If they were to take a third of their profit for rewarding themselves, a third for investing in the business, and a third for rainy days in the future, that would probably be the best sensible plan for dealing with that profit that they're hoping to improve on. Conversely, a loss is when the revenue from sales doesn't cover the cost of production. There's not enough money left. Losses can be reduced or turned into profits if we can find different ways to reduce costs. That might involve getting rid of staff and replacing staff with machinery, looking for cheaper materials and suppliers, but that's not always good for quality, and Aaron Furniture have got a reputation for being a quality supplier. Or you could get the money coming in quicker by cutting prices to sell more products, finding new markets, which is what's been suggested, and improving the quality and the sustainability of the furniture. Lots of opportunities there to turn loss-making business into a profitable one. If you get a question on Friday asking what's the difference between profit and cash flow, then it's quite straightforward. There's a significant difference. Revenues, or money coming in, turnover, eventually becomes cash into the business. Costs become cash paid out of the business in terms of payments to suppliers. But cash flow, or the money coming in, or the difference between the money coming in and money going out, is not the same as profit. Profit is what's left after all bills have been paid. Cash flow is literally the money flowing in and around that company, in and out of that company, and what's forecast to be left at the end of each month in that company. Obviously, in terms of timings, there could be differences if the money's coming in slower than we expect it to come in. If more people have made purchases on credit, i.e. buy now, pay later, so I'd avoid all those things. It's very much a case of if people want the best, they need to pay when they order, and that's the advice you should be giving to Aaron Furniture. This buy now, pay later is, I think, a thing of the past when it comes to running a profitable business. Accounting for fixed assets like the land, the building, the machinery, that's all treated as capital assets, not costs, but all those things depreciate, and that depreciation is charged at a cost to the business, but is not a cash cost to the business. It's a paper cost to the business. Financing from the business can always come from the owners. That's treated as capital from the owner's fund. Loan repayments are repayments of the liability the business has, and it's never had as many as it's got at the moment, so those loans need to be repaid as quickly as possible. Dividends and interest are both costs to the business associated with paying these two items. So there are some differences between what's a cost and what's cash going out of the business. And I think you've done well, because that's going dark now. As you can see, you can't see the garden anymore, but you did that in less than 9 minutes.